Hey, what's up? Kenny Glick here with another reminder that this weekend, April 16th, I'm going to be doing a class. So get your feet wet ahead of my favorite time of the year to trade, and it's earnings season. Get ready, April 16th. Join us for 3 hours because earnings season is coming. So what are you going to get with this class? You're going to learn everything I could possibly tell you. The VWAP basics, how to build the watch list, how to optionize my trades by learning about the options, learning about the setup so you can use options only, because I know you guys love those options. You're going to know why the earnings reports matter. You're going to be able to differentiate between stocks you want to trade while you don't want to trade them. You're going to learn the significant price levels. You're going to learn the entries and the exits. You're going to learn basically every chart pattern that's made me the best trader ever. I'm also going to give you a list of earnings that are coming up so you're ready and prepared. You're also going to get another secret perk that's probably going to be worth about $500.
Wow.
And of course, I'm going to show you guys with $5,000 or less how you can do this too. All right? See you April 16th.
See you April 16th. Hope you guys are all signing up for this amazing Warlock event. But right now we're switching it up and diving into the crypto world with our friend Nick Black. Let's bring this man in 5, 4, 3, 2.
Pew pew, pew pew. Because I'm from the streets, bro.
That's how
from the streets.
That's how we enter the show. That's how it happens.
Some people learn it in the books. Okay. Some people go to the universities. I learned it in the streets, bro. Did you learn it in the streets too, Eric?
No, I didn't learn much from the streets, man. Suburb guy here.
Did they have mean streets where you grew up?
I mean, you're making it sound like the streets. I didn't have the streets. I just had like on the block, man.
What hood were you claiming? What set were you claiming?
Nothing. Just
what?
Just it was all about education, man. It's all books.
Dang. Who was El Jefe on your block? Who ran the yard?
Had no El Jefe. Had no yard even, Nick.
No one was catching pockets, huh?
No, I don't even know what you're talking about. So man, over my head. It's crazy.
You probably don't have one toothbrush that's sharpened at the edge that you could stab someone with, do you? Not even one.
No, and every month or so I get a new toothbrush head because I use the electric ones. So, I just replace the head on top. No, I do not shave them down. Yes. But I should be using whatever you're using because you have the brightest and whitest and straightest teeth ever. So
I have one of those things because my dentist said you have to have one that like shakes. It shake. I don't know what they're called, but they're anyway. I've got a blue one, and the first time you do it, it drops you to your knees. It's such a weird kind of a. You're like, and then you vomit.
I think I need that though. I guess, Nick. That sounds amazing. But hey, what are we doing today? Let's pop up on the screen what's actually happening here today.
Welcome to Alternative Wealth Daily Live, where every now and then we give you some good information that you can use, but mostly we give you some kind of mind-numbing rubbish. But in that rubbish, there's some gold in them there hills. So we'll talk about the markets. We'll talk about, gosh, if anybody got to watch the GM of the Dallas Cowboys butcher that press conference, that is golden. Is the best advertisement for blockchain.com. So we'll talk about that. Oh man, he gutted it. It was awesome. So yes, crypto companies can now waste even more money by sponsoring NFL teams full of people that watch games that do not care about crypto at all. So more wasted money. I heard someone yesterday, there was a very interesting interview Mike Green did. For those of you who don't know who Mike Green is, he's really good. He's an analyst. He pretty much hates crypto, but he hates the meminess and the squirminess for the right reasons. He's a math guy, and he also understands trends very well, and he realizes that most of what's going on in the crypto space is spammy nonsense. And that is true because we have 12,000 plus assets, and there's about 100, maybe 100 decent ones, but probably like 8. And so he was looking at all this and he said, when you get to the cycle, to the part of the onboarding cycle where these companies, instead of innovating, they just start throwing sponsorships, naming rights, logos, and all that. When that's their business model, like FTX, Crypto.com, look at the companies that spend all of their public facing money to put their name somewhere instead of innovating in the space. That you're near a peak or an all-time high. That was October, November of last year, which is that was the big spamminess, right? And so it's funny to watch this interview, which is a few months old, and see the things that they were saying come to fruition. They said, look, when you see this, it's a bad sign. So when you see this, when you see these sponsorships being the thing instead of the technology being the thing, you should be a little bit worried. I would urge people in their minds to settle in, strap in, whatever you want, whatever is your metaphor that you like, for 6 to 8 months of very choppy, very volatile, very uncomfortable markets in the crypto space. You're going to get beat up, and you're going to get beat up bad. So, but on the other side of it, if you're investing in quality assets in those kind of moments, you do very well coming out the other side of it. Most of the money that I made in 2020, 2021 wasn't because of anything I bought in 20 or 21. It's because of stuff I was buying in 18 and 19. So that's where you should be thinking, when these markets are turbulent and they suck, you're buying quality assets, you will end up winning, but you have to have a little bit longer term vision. But the next few months are going to be gross. So just be okay with that. And be confident in looking at value and looking at fundamentals and actually, reading about these creeps that run these companies and being able to call them out when they pull shenanigans. Like, Eric, did you hear, you were familiar with the Charles Hoskins thing where they got on and partnering up with Snoop Dogg and Clay, that thing. That was a horrible, in my opinion, that was not a check mark for Cardano. That was actually, in my opinion, and I'm a Cardano fan, as you know, and I'm a Charles Hoskinson fan. That was a huge fail. I mean, it was a huge, embarrassing fail.
We didn't see anything actually come of that. Nothing really, promotion wasn't there. It really didn't do anything. It's down just with everything else today.
They could give away free $100 bills on the Cardano NFT network, and no one could access it because that's how bad the NFTs. Now listen, the NFT space is not built out in Cardano because Charles smartly didn't care about NFTs. Right. He's focusing on governance as a service in Africa and Central and South America, which is where they should be focusing. And he's focusing on bridging artificial intelligence, narrow AI, and the iterative steps towards AGI with Singularity Net and Singularity DAO and NewNet, which is important. Those things are important. Clay NFTs with Snoop Dogg. I love Snoop Dogg, and I don't have anything against Clay. I've always liked Clay. Even as a child, I played with Clay. But those three things together are not where the focus should be for Cardano. We shouldn't be spending time. We shouldn't be having press junkets. We shouldn't be having Charles get out there on Twitter Spaces and try to drop F-bombs every 10 seconds so that he can sound woke AF with Snoop and these other guys, because you're not winning anyone's respect, Charles, when you do that. All you're doing is embarrassing the people that are following you because you have actual just cause, right? Like, so there, that's my little spiel there. People were like, you're pro Cardano. I'm like, well, not when they do something stupid. So anyway, when you see stupid behavior all around the market, you got to like take a step back and say, is this a one-off or is this just where we're at? And also, what's the landscape? So behind all of your decision making, remember, the Fed is going to raise and raise and raise and raise, and they're going to raise rates because they have to now, because they've been embarrassed into it. So they have to continue to raise until CPI, forget inflation because inflation's nebulous and it's probably not actual what we're looking at as inflation, but CPI, the prices people pay, until that comes down, the Fed is not going to go back into an easing cycle. So the same DNA. So Eric, when you look at the crypto space, who do you think is the kind of average investor in the crypto space?
The average investor would
Like who
What do you,
in your mind, who do you think, like, who invests in crypto?
I think, well, that's a difficult question, Nick, because you have a lot of different types of people. You have the stimulus check people that know absolutely nothing and just want to dive into it. You have the people that know a little bit. They know that, you know, Bitcoin, Ethereum are pretty stable, so they want to put money in there and have it hold for a long time. And then you have people like yourself and like all of us in the chat are trying to be, is the informed people that are going to try and invest in protocols and things like that. And then you have the trader people that are in and out of assets all the time. So I think we have a lot of different types of people. I say, are you talking about the masses? Like, what is the mass of people in crypto?
Yeah. Most people in crypto, I think, are the equity investors, the same people trading in equity markets.
Okay, I was not going to say that, so I'm glad you did. Saved me from a wrong answer.
No, it's not a wrong answer. You're right to an extent, but I think Joe Sixpack basically got pushed out. But remember, so if we backtrack about 2 years, we had COVID, we had all of the stimmy checks, people got paid to sit on their couch. There's a lot of dumb money. Also, rich people got real rich during COVID, right? Because they get to spend money pre-inflation. They get to invest in things with all of the windfalls that Joe Sixpack does not get to invest in. There's a reason why 90% of the stimulus money, and I'm actually on the nice side, 90% went to the top 1% in society. That's not flummox or tomfoolery. That's just the way it is. It got hoovered up into a very small group of people that have all sorts of other opportunities. So Joe Sixpack took their money, they punted it, they're gone. See you later, bye. And then who do you have left? Well, you do have a core of investors like us, me, you, the team here at Money Morning Live, and people that are just out researching, trying to figure out, how do I skin this? How do I make my life better by being in the crypto space? Well, that's a small group, but the main group is the hedgy, institutional hedge money. So not the institutional money like colleges and universities and endowments, but like hedge fund money and VC money. They're in here to skin it. They don't care about the space. They could light it on fire for all they care. They just want to make money real quick and skin the arbitrage, the information arbitrage, meaning that we don't have access usually to the same information that they do. We also don't have access to buy tokens at 4 cents and then get behind a huge publicity campaign and pump it out to a bunch of idiots, which we are the idiots, at $4. And thereby they get to rack back 100x before their crappy asset ever hit the market. And we take it and we're like, oh, thank you. Thank you for this incredible opportunity. And we pump it to $12 and we're like, woo, we made a 3x selling it to more dummies while they cashed out 100x. And they just wash, rinse, and repeat. We can't do that. So we're forced to the weapon we have is game theory and a little bit of math and just reading, right? Like we just have to do our research, look at the teams, and our game is a long game. The VC game is an early game. They get it, they print it, they spew it on society, and we buy it because we're dumb. But maybe we buy the right dumb stuff because we have a longer term perspective, a more value-based perspective. And we can still win. We're never going to win the way VCs win. So get that out of your mind. None of us here, none, are going to be able to do what they do unless somebody here has $150 billion that you haven't disclosed in the chat. And by all means, please email me privately if you do. But the reality is we have a very limited kind of access to information. It's better than it was in the .com era, but let's rewind all that back to the original thesis. What's the DNA of the average investor? The retail and the equity investor. That's the main investor in the space. If you back out the VCs and you back out us. And because of that, this market is going to probably track the equity market. If money is harder to get, harder to borrow, and more expensive, that's going to put the brakes on the crypto space a little bit. Not in value plays, not when you're buying good teams. The way we invest, it doesn't matter. This is the beauty of it. If you're a value investor, most of the stuff that I've said, other than that we can't compete with VCs, which we can't, but in the long end, we can actually do just as well because we can grab the 100Xs by being in quality assets with quality teams that solve a variety of issues in society, that has a reason to exist, use, utility, the potential for worldwide adoption. There's many of these things that VCs don't care about. Well, they don't care about any of those things. They just pump and sell it. Well, that's fine. We care about the longer term vision. And you did really good if you bought Netflix and go through the fangs, right? You did really good even if you weren't in the beginning. If you just held on and said, I think these things will change the world, you did really good. So that's what we're trying to do, is have longer term vision and do the same thing. Okay, so, but why this is important and why I'm starting out this with today, normally this would be our strategy session, but I wanted to lead with it because when you see the Fed hiking because they're clueless, but because they are politically stuck and they have to hike, they're going to hike well past the point where CPI comes down, which it will. But remember, it took 2 years for all this crap to kick in. It's going to take a year or two for all of it to unwind. So we could be seeing CPI still not lower, not significantly dropping back down for another 12 to 18 months. In the same way that it took kind of 12 to 18 months to ramp it all up, to inject all that, funny money into society and all the other kind of moral, turpitude and perversion that occurred because of it. So this isn't like if the CPI drops back down to 5, the Fed stops. They're going to continue to hike. They got to get at least 1.5 points, which sounds crazy, but they have to, so that they can cut, which is the most ridiculous thing if you think about it. Like, it starts to sound nonsensical, but they got to raise so they can cut. They have to raise so they can earn the right, public facing. Otherwise, no. Anyway, that's what I have to say about that. So we're going to have some months of turbulence and disquietude, and you should just be okay with that, because our game doesn't change. We don't change our strategy. We still swing the same at every fastball. It's just, we have to be very careful. This is when the 5 T's become really important. The team, super important. This is when the team matters, because they're going to be feeling the pressure too. And if the team gets squeezed and they break, then the asset breaks. So we don't want that. So again, team, technology, timing, tokenomics, and token. And that last part of the token, why token? Make sure you're asking yourself, why does this token even exist? Does it make anything better? There's plenty of really cool companies with great teams, cool-ish technology. The timing is, we don't know about the timing, but the timing seems fine. The tokenomics seems okay, except that it's based on a token that doesn't need to exist. An example is the Brave token, BAT, B-A-T. Brave is an amazing browser. I'm using it right now. It's awesome. It stops pop-ups. It rules. But they don't need their own token. Like, well, we sell advertising. Well, you could sell advertising with any other token. What kind of token is it? It's an Ethereum. It's the ERC20 token. Okay, cool. Why don't you just use Ethereum? Well, because we can't get rich. Right. Yes, I got it. You can't get rich. Now I understand. Okay. So make sure that all of those T's are factored in. Don't get like 3/4 of the way, be like, the team is cool. The token makes sense. I'm buying. No.
Thanks,
Take
Nick.
your time. Slow it down.
I like how you were very transparent, letting us know what we should be expecting, but also letting us know that we should be staying the course. Because as I hate watching the markets go up and down, and I sit here and watch them all the time, which I shouldn't do because I'm not trading in and out of them. And some days you feel great. And then the next day you're like, I felt great yesterday, but today I don't feel so great. But in the end, you still believe in the tokens. You still believe that they're going to be up in the end. So just stake where you can. And the end game really doesn't change. Just maybe don't watch it every day.
Yeah, the beauty. Well, and you can watch it. Look, I watch it every day. I've been on dates. Check. I actually, I've got an apocryphal story that I won't tell, but I've been in a situation where I shouldn't have been checking my phone.
Oh, Nick, I could imagine. But this just in, Nick Black goes on dates. He's dating. Get your calls in now. He's available.
Well, this was during a very successful date.
Okay.
I get where you're going. And this is all I had.
But what we do have, Nick, and I love your extended intro into the video, into the show. It's just become typical, but we do have some crypto headlines that we want to touch on. And Nick, you already did talk to us a little bit about the Dallas Cowboys, right? So here we have a little bit more. The blockchain.com closes a sponsorship deal with the Dallas Cowboys. They have more fans than crypto companies have users, Smith told The Block. For this, it's a customer-first partnership, but Texas is obviously a big home for Bitcoin mining, so we'll be doing some institutional stuffs. What do you think? I mean, obviously, I know what you think of this. You think it's just kind of a joke, but any value here?
It's a joke. Look, Dallas is big. You have a few franchises that have global recognition that are kind of just A-list quality, pristine sponsorship collateral, right? And that is the Dallas Cowboys, that is Manchester United, that is the Yankees, that is the Lakers. There are a few stalwarts. Well, the Cowboys are they may be the highest priced sports franchise on earth. I think they are actually. And I think only close to, it goes like Dallas Cowboys, Manchester United, Yankees, Lakers. I think that's actually the order. But the point is, so this is good for blockchain.com. The thing that, look, this is good for blockchain.com, I guess. I don't know that the money makes sense. I don't know. Look, it seems like people would stumble across blockchain.com. It's almost one of those names that's so on the nose, you don't trust it. Like, for instance, crypto.com. By the way, there's a lot of reasons not to trust crypto.com. I will just urge everyone, you do you, but if me was doing, that sounds bad. If I was managing your affairs, I would not let you put money in crypto.com. They pulled shenanigans in the past. The team is essentially the same. Why would they suddenly we're good now. We're not going to be the D-bags that we were before. We're not going to freeze people's accounts. We're not going to just lose stuff like we did before. So anyway, but blockchain.com, well, a little bit on the nose. I get emails from them all the time, and I'm always like, is this real or is this some kind of sketchy thing? But anyway, they announced Wednesday the close of a sponsorship deal with the Cowboys. It's part of this broader marketing push, which again, we just talked about, is never a great thing. When you're focused on more marketing than development, I'm uncomfortable with that. Uncomfortable. So the deal comes as companies across the industry ramp up their marketing spending, particularly in the area of sports. Major sports franchises have eyed crypto as a way to get and expand their fan outreach. Recent deals include Bybit's 3-year, $150 million deal with Red Bull Racing. Does anybody look, man? No one watching a Formula One car, a Red Bull, they're not thinking, oh man, did you see that Bybit sticker? That 1 by 1 inch sticker? That is amazing. I'm going to go set up a rando account. You guys remember Insight? Eric, you remember Insight? I know you do.
I actually don't, Nick. No idea what it is. And you didn't give me time to Google search it. So no.
Don't say no idea what it is. Google it.
Insight?
Does anybody know what Insight is? You got to know. This was one of the biggest scams.
ENZYTE? Oh, is this like a supplement?
Yeah, the other blue pill.
The natural male enhancement. No, and that's why I don't know this, Nick.
Oh, yeah, no, Eric doesn't know anything about it. Yeah.
I don't.
Okay, look, the whole thing was a scam. And what were they doing? They were FTXing and buy-bidding it. They were on race cars. They were full commercials at the Super Bowl. They were doing all of the same in-your-face shenanigans, and it was a complete scam. So, I mean, like Enron level.
Was that like
Enron?
Like the ab zapper thing? I bought that back in the day. The strap-on thing, and it like zaps you.
Oh, I bet you have a strap-on. Do you have a shake weight, Eric?
No, never bought the shake weight. No. I go to the gym.
And the guys, you're like, no, stop.
Fantastic marketing, right? Fantastic marketing. I mean, they made $1 million off the shake weight. No,
I don't know. I'm sure people got injured by that thing. But anyway,
probably.
Long story short, there have been a number of companies that just focus on the advertising and not actually on product, and that's uncomfortable to me. So anyway, so they had the $150 million deal, Bybit, which no one cares about. Crypto.com's $175 10-year deal with the UFC, not to mention I don't know how many hundreds of millions they got for the naming rights of the stadium, I think Staples Center or what, I don't know. Look, the crypto sporting intersection is fully on display. If you watch the Super Bowl, you saw 3 or 4 companies with their ads. Some of them were okay, right? The Larry David one was actually a really funny commercial, and that was FTX. And I'm not a big fan of FTX. I mean, I hope I'm proven wrong, and I hope that Bankman Fried Chicken turns out to be a decent dude. But so far, he just looks like a rube, Ponzi, puppet, putz that's being dangled for other reasons by other people. We'll see. But this newest ridiculousness is with the Dallas Cowboys. Now, I could read you this article, and I'll read you a couple more things. But you have to go, dear God, man, you want to get a laugh, go and look at Jerry Jones butcher that press conference. He did not get the name right one time. These dudes gave him so much money, and he didn't get the name right once. It was awesome. Their partnership with the Dallas Cowboys, blockchain.com, announced by general manager Jerry Jones, and the exchange CEO Peter Smith, who, by the way, was kind of doing one of these, like trying to act all glib during the press conference. But every of the 40 times that Jerry Jones butchered his name, you could just tell it was like the death of 1,000 name butcherings. It was awful, including the ability for blockchain.com users to access cowboy related content via the mobile app. Wait a minute, Eric, it's finally happened. This is the killer app for crypto. Trade crypto while getting details about the Dallas Cowboys.
I am not a Dallas Cowboys fan. I'm a Giants fan. I hate the Dallas Cowboys. I would not use that app.
Would you use the app if you could trade crypto and get details about the Giants?
No, it's awful. I mean, the Giants are bad, so there's no good details to get. But no, that's like, it's like it's stupid. It's like putting two things together that don't really belong together, right? That's what we're looking at.
It's peanut butter and pickles and mayonnaise and ketchup and salt.
Now, Nick, side note, with that said, everyone knows peanut butter and jelly, but do you know peanut butter and fluff? This was a thing we were talking about a few months back in the broadcast channel. Have you ever had peanut butter and fluff, chat? Have you had peanut butter and fluff? It's the spreadable marshmallow that you spread. Real good stuff. It's real good. Peanut butter, yeah. Art chick knows. Yum. Okay.
I just puked in my mouth. My puke vomited. My vomit just threw up.
Oh, it's delicious.
3 layers.
Fluffer butter. Fluffer nutter. Okay. It's about
not what fluffers are. That's not what fluffers
50.
are.
Oh God, Nick. Shall we move on to our next? What you have say your joke, Nick. We're ready. I'm listening.
There's no joke. I'm not going to tell a fluffer joke, but we all know it's in the pipe. It's just one click and a bang from firing. Okay. I think this last statement sums it up. And this is from Mr. Smith. You won't be able to escape crypto and blockchain.com even on Sundays.
Ooh.
It's so stupid.
Yeah,
it's so
cheesy.
stupid. There's not one person, I'm going to go out on a limb. I don't like absolutes, but I will go out on a limb and say there's not one person that's going to watch a Cowboys game. First of all, not one person that will watch Cowboys game and be happy. But there's not one person that's going to watch Cowboys game this coming season and go, it's time, honey, it's time for us to go and buy us some of them crypto tokes. It's time. Come on, man.
Yeah.
This is just dumb. And I get it. You want a brand. You want to put your name out there over and over and over so people are like, oh, my God, there's no choice. I have to buy this thing or whatever. But it's not even a thing that you can buy. It's a place that you go and I can Cowboys pictures and I can get some kind of Bitcoin on an exchange I don't really know and probably don't trust. And there's a reason that I both don't know and don't trust them because I shouldn't know about them because they're untrustworthy. And insane. Where are we going, Eric?
Well, Nick, we need to talk about how much of a stablecoin allocation is too much. And here, the crypto portfolios, how much stablecoin allocation is too much? Stablecoins allow investors to stay on the sidelines and earn passively on their holdings, but not all stablecoins are are created equal. We know this. I mean, you drill this into us, so tell us more.
Yeah, I think so. There's some subtler points. So I'll go through the main details, but then there's some subtler points. First and foremost, I think 10% is a fair allocation to stablecoins, and if you can earn some yield on them, that's great. But I would be very careful because the yield has to come from somewhere. This is something that I think it's not a subtle point. If they're deriving some yield, you should ask, how is this yield achieved? If they're honest with you, it's through some form of lending. Okay. If they tell you we just pay it, you say, well, wait, what? How do you just pay it? Where does the extra money come from? If I have a $10 bill and I leave it like on my desk, I don't just come back and there's like an extra $2 the next day. Like where did it come from? It didn't just boom. It's not like a mogwai. It's not a, what are those little, a gremlin? But before they become, it's a mogwai, right? Before you get them wet and they pop out more.
The cute ones, when they're cute still, yeah. They're like fuzzy.
Yes.
No idea what they're called.
They pop. I think it's a mogwai. Mogwais don't just make more mogwais unless you spray. $10 bills, you can spray them with as much water as you want and it doesn't pop out another money. Okay. So when your money pops out money, you need to ask, where does the money come from? If it comes from lending, cool, I get it, but they have to be honest about it. If it comes from repledging those assets in different places, it starts to look more like the repo market where, you know, there's a lot of weird lending and then people lend the things they borrowed and then they lend them to other people and those people relend and relend and relend. That is rehypothecation or repledging of assets. If that's where the interest comes from, I would be wary. But when things like UST, not USDT, which is also sketch, is not backed by dollars. This is the idea of these algorithmic stablecoins. So you have different classes of stablecoins. There's three classes, the way I look at it. There are one-to-one dollar-backed stablecoins, which unfortunately don't really exist. USDC would be the closest thing, and they are 50% backed. And you say, well, a true one-to-one backed stablecoin, how could a company manage that and make any money? And that is a fair question. They can't. There's no spread in there. So they're either lending, performing some kind of arbitrage function, a part of some liquidity pool, or there's some way that yield is being derived. Lending makes the most sense because it's kind of like cognitively it makes sense. Well, then we have the other kind of stablecoin, which is because we don't have really one-to-one stablecoin, right? A dollar stablecoin backed by dollar. We don't really have that. But whatever. Then you have we'll lie and say it's backed by a dollar, but it's clearly not backed by really much of anything. And that's like USDT, Tether. And then we have the completely uncorrelated algorithmic stablecoins that are backed by other crypto. And the idea is that they're so over collateralized with a lot of cool math and algos gone wild that they just move money back and forth and burn other coins to maintain a dollar peg. You know a real easy way, Eric? The easiest way to maintain a dollar peg?
How's that?
Have dollars.
In the bank?
I don't, yeah, just like if you issue 100,000 XYD stablecoins, have 100,000 USDs in the bank for that.
That makes sense. Makes very good sense.
Algorithmic stablecoins.
Wise.
The idea is that the crypto community, the crypto ecosystem, the landscape gets bigger and bigger and bigger, and you have all these other stablecoins that you could burn or sell to increase the value in a liquidity pool to maintain a dollar peg. It's all very, very clever, and they will assure you trust us. The math is correct, because when people tell you to trust them, you should definitely trust them, right? Like if you're ever meeting someone, they're like, trust me. Nope. If you gotta tell me to trust you, I don't trust you, right? Or like in the movies, Eric, my favorite line in the movies, you gotta believe me. Why? I ain't gotta believe nothing.
So
you just said your grandma has vampire teeth. I ain't got to believe nothing.
You seem like the guy that just doesn't trust a lot of people, Nick.
I'm
You have
very distrustful.
you have trust issues, don't you?
I'm very distrustful.
I think so.
So-
But that's okay. It's safer, I guess.
So those are the three stable coins, right? You have the stable coins that are backed one-to-one. They don't really exist. They're just kind of like glimmering pastel fairies. Then you have the, it's clearly not backed, but we'll lie about it kind of stable coins. That's like Tether, which we all know they're lying. They know they're lying. It's like there's two people in an elevator and like you smell something. You're like, oh dear God, you both know who did it, right? You both know who did it.
It's you.
There's no point lying. Neither one of you needs to lie. We get it. I know I didn't. You know you did. We both. Okay. So then you have the algorithmic stable coins and they're like, trust us, trust math. But, and this is my problem, like with the whole Terra Luna ecosystem and all that, you can't throw volatile stable coins in a bucket and call that the backing of a stable asset. I don't know how you go from extreme volatility and low liquidity and sketchy exchanges and somehow on the other end, you spit out a stable asset, because at some point that unwinds, especially when you pay they pay 19% on UST. Think about that. Why nowhere else in the world do you see numbers like that? Because it's impossible. You can't maintain that. So it works like Social Security. As long as money flows in, everything's fine. The minute, and this is kind of like that passive indexation effect, right? You go into a passive fund, more people go into passive funds continue to buy across a range of assets. Those assets all go up. That's fine until somebody starts selling. And then there's no buyer of last resort. There's no buyer at all. It's just gap down markets because there's only sellers, because the buyer of first and last resort has become the seller of first and last resort. There's no one to pick up the bid. So this likely will occur to some extent. And that's why Do Kwon is as fast as he can. He's trying to pile money as fast as he possibly can on the other side to over collateralize UST. He's trying to get it systemic. He's trying to inject it into as many networks as possible. That's why they are kind of teaming up. If you noticed the news yesterday, most of you didn't because you're not nerds like me, that both USDT has launched in the Polkadot ecosystem as well as UST. So they're trying to get these things out there as far and wide as they can to make them systemically important. The idea is, I think, a too big to fail scenario, but that's different. Because then you have people come and bail them out, but I don't know that there's anyone that can come and bail them out. And then they're like, well, we'll just back it with Bitcoin. Okay, cool. Except that what happens when Bitcoin sells off or it gets deranged or dislocated, or for whatever reason, some rich guy sells 250,000 Bitcoin because he's just done and he crashes the market 20K. And then your stable coin unwinds. And then the $1 billion over there gets evacuated. And then all those people that were involved get hammered to dust. So these things can happen. And I just don't know if backing a wacky market with even wackier assets equals stability, no matter how you stack it. And then again, if you need $100 million to stabilize $1 million, I don't think that's very safe either. It's just like at some point, bro, math. When you hear, sometimes when people are just getting all whimsical, just go, hey, bro, hold on, math. And just walk off, drop the mic. Matter of fact, you should have a mic that you can drop after you say math. So cryptocurrencies are well known for being volatile assets, which means that experienced traders have plenty of opportunities in the space. Now, there are some stable coins that make money by arbing back and forth in these liquidity pools. Like, for instance, the same asset could be traded on a variety of places at slightly different prices, and you could go in there and snip little bits here and there as long as the fees for doing those transactions get low enough. That's arbitrage. And there is a certain amount of arbitrage, but the more, veteran these markets become, the bigger they become, the less opportunity for arbitrage. Arbitrage is like a Wild West type thing. And that becomes less and less the more people and money units that enter the market. So stable coins, which is a class of cryptocurrency that offer investors price stability, they say, pegged to the value of fiat currencies, offer investors a safe haven when market turbulence hits and may represent missed opportunities over time. So let's reduce all this. We know what the different kinds of stable coins are. We basically understand the risks. Some of them are completely ridiculous. Some of them are not so ridiculous. They break down UST like this. They say it's a non-collateralized algorithmic stablecoin. An underlying asset does not back it. It works through algorithmic expansion and contraction to maintain its peg. Now, I like the idea of government currencies that can expand and contract. They just don't ever, the contraction part doesn't seem to make it to the list of things that we should vote on, right? Like everyone loves to, you don't get hired as a public official for being the guy to say, no more bridges, no more roads, let's fire teachers, right? Like that's not the dude that gets elected. The dude that gets elected is the one that's like, more bridges, more teachers, we're gonna, and then we gotta, and to build those bridges, we need construction guys. So we need schools to train construction guys. Everybody's like, yeah, this is awesome. And you expand but if the currency supply doesn't also contract, then you don't have that kind of elasticity in currency that I think is needed to manage people. Well, the way Terra would do it is with their own funny money coin, right? So Terra, the blockchain behind UST, has been building up reserves for its stablecoin, which, by the way, you wouldn't really have to have a bunch of rando reserves that are worth way more than the coin if it was properly algorithmically balanced, would you? Like if you need 10 billion to manage 1 billion in stablecoin, doesn't that seem like that 10 billion is wasted? Like I just don't know what the benefit of that is. If you lock up that capital, couldn't that capital be going in different places? Like research, advance and R&D and expansion and growing, making society better, or how about curing perfectly curable diseases like in sub-Saharan Africa? Like I'm sure there's a lot of places where gummed up money could be. When you see capital gummed up in something like this, that is an inefficient and wasteful use of that capital. Where you could just put a 10% of it in the actual currency unit that you're trying to back and just leave it there, right? Like they're doing all this, they're overcomplicating it by a factor of 10, a magnet. So whatever, but these algorithmic stable coins are here to stay, and all these companies are going to take shots at it, and many of them will fail, and many of the people that are gambling will make a high rate, a 20%, 18, 19, 14, until they blow up and these things unwind and they get nuked and they go, I don't understand. And then they will do the math a little bit, and then they will understand, and then they will be uncomfortable. You have Abra Capital Management, the asset management arm of crypto investment firm Abra, which, told Cointelegraph USDC and other US regulated stablecoins are as safe as keeping reserves in a bank account. Well, USDC is the best in breed. So let me reduce all of this. I think it's fair to keep some stablecoin in your portfolio. Don't think that you're going to make money on it. Don't think it's going to make you rich. You need to have it so that when these quality assets sell off, you have a little bit of dry powder, right? No matter what, when the market is going up, pull some stable coin to the side. Look at your winners, clip 2, 3, 5%, and just make sure you have a little bucket of stable coin, because you don't know when you're in November of 2021 or when you're in March of 2022, right? Like you don't know where you're at in the cycle, in these kind of vacillations of these markets. We don't know until afterwards, right? Until 6 months later, and you go, oh man, I should have been buying. I should have been doing this. I would be very hesitant, incredibly hesitant, to be involved in algorithmic stablecoins right now. I think the team at Coty, it is testing an algorithmic stablecoin that was developed at IOG, at Cardano, the team there. It's called the JED, DJED. Don't buy it, but I think that's probably the best version of what an algorithmic stablecoin might look like. And I say that because the best mathematicians are there. The best mathematicians in the world are not at Polygon. They are not Do Kwon at Terra. And they are definitely not at the Fed. So don't be enticed by these high rates, these yields, 20%, 19, no. Stay away from it. Have some USDC, which I think is fine. Be smart. Don't get greedy. Save a little dry powder. And that's all I have to say about that.
Well, thank you, Nick. I appreciate that. And you know what I'm about to do? I'm about to flip the script a little bit because we had a question come through email right now. Yes, this question, and we're going to get back to the market update, but I wanted to address this one really quickly. So I'm going to look over here to get the question. It says, Alternative Wealth Daily, or the network, recently had an article on cold storage. I use this. I've been in crypto since 2017 and was an early subscriber to the microcurrency trader. Nick talks a lot about staking. How do you keep your assets in cold storage if you're staking? Now, I know there's not an easy answer to this. I know that's not the easiest thing to do, but maybe how do you, and if you can't, how you would take them off there to put them in a place for staking?
So it's platform, it's going to be protocol specific, meaning that some protocols will allow you to stake from cold storage, because all you're doing with staking mostly is pointing your tokens towards a validator, and that gives that validator, it makes them more famous. Think of like elected representatives. I have a validator. I have a representative. I vote for him. Well, in proof of stake, my tokens are my votes. I'm pointing those at a validator or a few validators, and that makes them more famous, more likely to win, right? To win an election, to win blocks or time periods, right? In Cardano terms, you have an epic, which is 5 days, and you have slots, little 20-second slots, tick, 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 tick. And the more slots that each validator wins, the more fees they generate, and then they distribute those to their flock of stakers, people like us that point our tokens. Some protocols allow you to stake, basically just to signal, to say, hey, I'm staking. Here's my tokens. They don't take the tokens. Like in Cardano, when you stake, your tokens don't go anywhere. You just signal that these tokens are going to be used to stake with those guys or those girls or those pronouns undisclosed. That stake pool. But you're not sending your tokens somewhere. Now, different protocols have different rules and requirements. Some have slashing, where your stake pool, if they do something sketch, they could actually take your tokens. When I see protocols that have slashing functions, I'm not likely to stake, because what if those dudes get greedy when I'm not paying attention? So here's an example. I was staking Graph token a while ago, and Graph token got pretty sketchy. Not Graph token, but one of the stakers, the staking pool I was using, they just decided, because no one was paying attention, for like a month not to pay rewards. They just pocketed it. So that was enough to make me not only never stake again, but I sold all my Graph token. The second this happened, I went to their chat. They're like, oh no, sometimes that happens. Sometimes? What do you mean? This has happened so many times that you can say sometimes this happens? Like if an alien landed on the White House lawn, you wouldn't say, well, sometimes aliens. No, man, that should be a very rare event. A stake pool should not be stealing from the people staking. If they ever do, not only am I out of that stake pool, I'm out of that network. Period, full stop, see you later, bye. So that's just me. So I would be very careful and look, each protocol is going to have their own specific rules for how you stake. Sometimes you can do it from a cold wallet. Sometimes you cannot. There's not like a one size fits all.
Well, thank you, Nick. I know it's a hard question to answer, but I think you did a nice job there.
I love questions.
I know you do. We have a lot of them, but we also have to get to our market update. So why don't we get into that? Take as much time as you need on it, and take us through the markets, Nick.
Well, it's easy. We don't have to take much time at all. Bitcoin's down about 3%, and so too is everything else. The only standout losers, Fetch is getting beat up a little bit. It really got crushed last week. Most things got beat up last week, but not gutted. But you know who's not a loser today? Singularity DAO. Why? Well, their Dynasets are doing really well. Their Dynaset for Ethereum outperformed the market by 18% in the first quarter. Their Dynaset for Bitcoin outperformed by 18%. The Ethereum Dynaset performed, I think it outperformed Ethereum by 16.6%. Let's call it 16%. That's on a quarterly basis. That means you're getting close to 80% on a yearly and close to Well, I'd have to look. They're going to start shorting. They don't currently short. So basically what Dynasets are, you can take your Bitcoin, park it in a Dynaset, Singularity, like a Dyna, DYN, BTC, or DYN, ETH. They're going to be adding other assets. And they algorithmically, quant-based and narrow AI manage through technology that was developed and sourced through SingularityNet. They manage those funds. So they haven't started shorting yet, and they're still way outperforming both Bitcoin and Ethereum. My guess is if they continue to do that, there would be no reason that most people would hold. Like, why would you even stake Ethereum, the 2.0 contract, or anywhere else, if you could take and park it at Dynasets in a Dynaset and you could grab 16% a quarter? Are you freaking kidding me? That outperforms everybody. Everybody. So, and we had talked about this a while back. If Singularity DAO works, that's probably a $40 or a $50 token. If it doesn't work, it's probably like 10 cents, right? I'm starting to think that we're going to be closer to the $40, $50 one, because if they get it right and they keep getting it right, then all it is simply kind of adjusting the math to make you decide, do I want to hold the Singularity DAO token or convert that to Bitcoin or Ethereum and park those and have the Bitcoin and Ethereum trading? Where I think the money is, as an investor, is I'm going to let them trade the smoke out of Bitcoin and Ethereum, and I'm going to let them continue to win. And I'm going to invest in Singularity DAO, the token. I'm going to stake it. I'm going to get those fat rewards, and I'm going to be so happy. So I'm very bullish the token. I'm very bullish that team. And so, yeah, I think there's a lot to potentially like with Singularity DAO. All right. What else is doing good? Well, we're going to see some near-term excitement, I believe, from AGIX and probably from NewNet. You say, well, why would we? Well, here's why. The 18th, before we see each other again, on the 18th, they're going to create into existence, well, it's already in existence on the testnet, where you can transition from the Ethereum AGIX and NewNet token to the Cardano version of those tokens, which can then be managed through the Cardano network, through Daedalus, staking, all sorts of cool stuff. Now, for those of you that are staking AGIX or you're holding AGIX to get the NewNet reward, do not do anything until we talk again. I'll have more information. So when they have this token converter and the smart contract converter and all this stuff go live on the 18th is what they're saying. Don't do anything. Do nothing. Pause. Let's wait and see what they say, because you wouldn't want to inadvertently move your tokens, your AGIX tokens, to another platform or another wallet and lose the staking rewards, right? Because the way it works, there's 4 staking periods where they take a snapshot. The registration period, by the way, is the 20th, where we will go on and we will say, hey, yes, it's me. I want my tokens. And then the 26th, I believe, they will shower us with free NewNet tokens, which is sweet. Okay. Sure, there'll be some selling pressure there. However, I like NewNet into the future. So I'm going to continue to stack the tokens. That being said, you wouldn't want to do something with your AGIX and end up missing your staking rewards for NewNet. So let's wait. What they said they're probably going to do is take a series of snapshots. And so if someone were to have moved their tokens over, they would have a before and after snapshot, and they would be able to, which sounds complicated, but computers, that they'll be able to know, oh, this is the stash of AGIX Ethereum tokens that got transitioned to AGIX Cardano tokens and then maybe staked or whatever. Therefore, they would still be kind of in the pool of investors that would collect the NewNet airdrop. And remember, it's not just NewNet that you're getting. So you're getting NewNet, but there's 5 or 6 companies coming this year where you're going to be getting airdrops because of owning AGIX. I'll tell you straight up, I was in the Singularity DAO initial sale, I bought, let's see, I bought two 25s. Anyway, at 20 cents a piece is what the token sale was. I got 2 allocations. So I got, I think 50,000 tokens, something like that. First of all, the staking is like 50 something percent. They have a 12-month pool. They now have a 6 and 12-month staking pool. And the staking rewards are ridiculous. They're like 35%, 50% for the 12-month. Well, anyway, so I've been getting staking rewards. I also got an airdrop from owning AGIX. I got an airdrop of Singularity DAO tokens, which is worth approximately $20,000. So I took the 20,000 of that. I immediately sold those and put it back into AGIX. I thought, well, I just want more AGIX, because if I have AGIX, I get all of the companies that they drop. I get staking rewards, which is a lot. And so think about a year from now when owning AGIX gets you 6 or 7 of these cutting edge companies, very forward thinking AI, AGI companies. Yeah. Are all of them going to do good? No. But if only 1 or 2 of these things is a home run, you hit a massive home run. They take 5% of the tokens of these new companies and distribute them to the community. So if you get a 20x on these tokens, you essentially got all your money back on the original underlying asset, give or take, depending on where the price is, right? So, I mean, Singularity DAO at one time was over $6. Like $20 is 100x. All you need is a 20x, right? So if at $4, I was at a 20x. I essentially had been gifted my entire AGIX investment was gifted back to me in the form of an airdrop of Singularity DAO. Now, I didn't sell any because I don't sell crypto. I buy crypto, and I believe that in the years to come, the value will go up compared to these stupid fiat currencies managed by criminals and idiots. But anyway, that's kind of where I am at with that. So I think Singularity Net, when people finally work out that you're getting these other companies' tokens, you're basically getting the closest thing to equity in these other companies that you could possibly have. It will be insanely obvious, absurdly obvious that you should have owned me, you do you, that me should have owned more AGIX. That's all I have to say about that.
Well, thank you very much. So it seems that you shared with us what some of your favorite assets are already.
Chew.
Yeah. And I'll tell you, Nick.
AGIX, bro.
Yeah.
Right now,
which is fair. But Nick, you know, we are not going to be live tomorrow. I'm going to miss you.
I mean, I'll be alive.
But we're not going to be live streaming, broadcasting here to.
Maybe I will. Maybe I'll just grab my phone, get on Instagram, talk to people.
That's true. You can do it from your YouTube channel if you wish. But we won't be live here at Money Morning live.
The other six people that watch that will be excited.
Yes, maybe they will be. But hey, today we have a lot of questions. We're gonna have to get back to them next week. I'm not throwing them away. Your questions are not forgotten. We're gonna save them.
Just so you guys know, Eric does throw questions away on a regular basis.
False. My computer storage is suffering from the number of questions that I have stored. That's what it is.
Your question cup runneth over. Is that the same cup that says America's greatest dad?
Nope, don't have that cup. Didn't we go over this already, Nick?
Well, last time we talked about world's greatest dad, but it's clear you're not in that category.
No, I'm a good dad, man.
What area of the world? What area you live in? Like what, Idaho or something?
No, that's Brandon. I'm Eric, broadcaster number 1. I live in New York.
Eric.
Yes, I live in New York.
Okay.
Brandon lives in Idaho.
In the rural, hayseed, rednecky town of where you live, can you get a cup that says rural, rednecky town where I live, best dad?
No, I'm right out of New York City, man. It's not rural and rednecky here.
So you're not even the best dad. Could you get what's the street that you live on? The block. You don't have to tell me.
I am not telling you. I don't trust you, Nick.
Poxitani Avenue or whatever.
No.
Could you say Poxitani?
How'd you know Poxitani? I could. I could have any mug I want made. have these connections. But hey, Nick, why don't we close out the show? It's been great. Thank you very much. And it's all you.
Thanks, everyone. Let's see. Stay in school. Don't do drugs that are not prescribed to you by a licensed professional. Don't do anything about poor, insolvent, drunk, strung out on meth grandmother, or Brerick, which we all know is actually Eric and Brandon, the same person, mashed into one, which we already knew. And they still, like through some weird multiple personality disorder thing, don't understand that they're the same person. But we all know they are. Anyway, don't do anything any of that group wouldn't do. And I will see you Tuesday. Pew, 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 pew,
Hey,
pew,
what's
pew,
up?
pew.
Kenny Glick here with another reminder that this week